Hey guys, let's talk about something that has literally made millions of everyday Indians incredibly rich, or, well, completely wiped out their entire savings. The stock market. Look, some people are going to tell you it's pure gambling. Others will swear up and down that you can make crores here. So what's the actual truth? Well, think of me as your friendly older brother here to tell you this. For people who actually understand the mechanics, the stock market is arguably the single most powerful wealth-building tool ever invented. But if you jump in blind, it'll chew you up. So today, in this explainer, we are starting from absolute zero. We're going to build your foundation completely from the ground up.
Here is our roadmap for today. We're going to quickly cover what a stock actually is, look at the stock exchange marketplace, decode what Sensex and Nifty mean, figure out bull and bear markets, and finally, get to the best part, how you actually make money. Let's take it one logical step at a time.
All right, section 1. What is a stock? Going from neighborhood shops all the way up to corporate giants.
To answer this, I want you to imagine something super relatable. Think about a local corner grocery shop in your neighborhood. Let's say the owner is a really hardworking guy named Mr. Ramesh. Business is booming, right? Profits are rolling in, and Ramesh wants to expand. He desperately wants to open a second, bigger branch across town. But there's just one tiny problem. He doesn't have enough cash to do it on his own. So what does he do? He comes to an investor, someone like you, and says, "Brother, invest in my shop. I'll give you 10% ownership. When profits come, 10% is yours. And if I ever sell the whole shop one day, 10% of that huge payout is yours too."
So you think about it, and you decide to back him. You hand him 1 lakh rupees. In return, Ramesh hands you a legal piece of paper that clearly states you own 10% of his shop. Now what's really cool is that this simple piece of paper, this actual proof of your 10% ownership, is exactly what a stock is. It's a share. It's tangible proof that you own a literal slice of a business.
Now take that exact same concept and scale it way up to massive multi-crore Indian companies. Think of giants like TCS or Reliance. Just like Mr. Ramesh, they also need money, but they need it for massive global expansions, or developing crazy new technology, or hiring thousands of people. Instead of going to just one guy in the neighborhood, they divide their entire company into millions and millions of tiny pieces. Each of those pieces is called one share. So when you buy a share of TCS, you technically become a part owner of that giant corporation. Sure, you might be a very small owner, maybe you own 1/10,000,000th of the company, but you are an owner nonetheless. And because you're an owner, when that massive company makes a profit, they literally share it with you. We call that a dividend. It really is that simple.
So now that we actually know what a stock is, where do you go to buy them? Let's move into Section 2, the stock exchange marketplace, where buyers and sellers meet.
Obviously, you can't just walk into a Reliance office building, slap down a 500 rupee note, and ask for some shares. You have to go to a highly regulated market where lakhs of buyers and sellers are meeting every single day. In India, we essentially have 2 main exchanges acting as the ultimate middlemen down in Mumbai. First, we have the BSE, or the Bombay Stock Exchange. Think of this as the older brother. It was founded way back in 1875, which actually makes it the oldest stock exchange in all of Asia. Then we have the NSE, the National Stock Exchange. This one was founded a bit later, in 1992. But today, it is the much bigger exchange where the vast majority of the daily trading volume actually happens.
The absolutely crucial thing to understand here is how a trade actually goes down. Because you don't interact with the BSE or NSE directly. Instead, step 1, you tell your digital broker, this could be an app on your phone like Zerodha, Grow, or Upstocks, that you want to buy, let's say, 1 share of Maruti Suzuki. Step 2, your broker's system instantly goes to the NSE or BSE, finds someone out there willing to sell that share, and locks it in. Step 3, the money is automatically debited from your linked bank account. And finally, step 4, that share is safely credited into your digital DMAT account. And the wildest part about all this? This entire 4-step process happens electronically in literally a matter of seconds.
Okay, so we've got the basic mechanics down. But when you turn on the financial news, they're rarely talking about your one individual trade. They're talking about the whole market. Let's decode Section 3, Sensex and Nifty Explained, the market scoreboards.
You know how you always hear news anchors yelling, "The market crashed today," or "The market hit a brand new record high"? What they are actually talking about are indices. These are basically the market scoreboards. Let's start with the Sensex. Sensex is the Bombay Stock Exchange's index. It acts as a quick snapshot, tracking the average performance of the 30 biggest, most established companies listed on the BSE. So, when the news tells you the Sensex rose 600 points today, all that really means is that on average, the stock prices of those top 30 giant companies went up.
It tells you there's a positive, confident feeling in the market.
And then we have the Nifty 50. This is the National Stock Exchange's index. Just like the name implies, it tracks the top 50 major companies across various sectors. We're talking heavyweights like Reliance, TCS, HDFC Bank, Infosys, and Maruti Suzuki. If these top 50 companies are doing well, the Nifty goes up, which generally points to a really healthy economy and confident investors throwing money in. But if they start falling, the Nifty drops, signaling that investors are selling off and fear is starting to creep in. Basically, these scoreboards give you the pulse of the entire Indian economy wrapped up into one simple number.
Now, speaking of market sentiment, whether people are aggressively buying or panicking and selling, that leads us perfectly into Section 4, bull and bear markets, the mood of the market.
These two animal terms are used globally to describe exactly what mood the market is in. A bull market means prices are steadily going up. Investors are super confident, lots of new money is pouring in, and there's a ton of upward momentum. Why a bull? Because when a bull attacks, it thrusts its horns forcefully upward into the air. On the flip side, a bear market means prices are falling. Fear is high, people are panicking, and everyone is selling off their shares to save whatever cash they can. We call it a bear market because a bear attacks by striking aggressively downward with its heavy paws. So just remember, upward thrust versus downward strike.
But here is the most important thing a beginner absolutely needs to know. Markets constantly switch back and forth between these two phases. It's a natural cycle. Just look at recent history. In early 2020, we had the massive COVID crash. That was a terrifying, vicious bear market. But almost immediately after, we saw an incredible post-COVID run in 2021, a raging bull market. Then things cooled off with a market correction in 2022, and then boom, followed by new record highs and another massive bull market in 2024. The big lesson here? Bear markets are completely normal, but over the long run, the Indian market has consistently trended upward.
All right, which brings us to Section 5. The section I know you've been waiting for, how you make money, the real power of the stock market. Let's talk about why companies go through all this trouble, and far more importantly, how you use this system to build serious wealth.
Real quick before we talk about your money, why did companies even choose to list their shares publicly? Basically, three big reasons. First, to raise huge amounts of capital. We're talking money for opening new factories, funding major research, or wiping out old debt. Second, it gives early founders and those early private investors a clean exit, a way to finally cash out on years of hard work. And third, it's about credibility. To get listed on the NSE or BSE, a company has to follow incredibly strict rules set by India's market regulator, SEBI. They have to publish their results every single quarter, undergo heavy audits, and be totally transparent. That makes them trustworthy to the public.
Okay, enough about the companies. Let's talk about you and your portfolio. As an investor, there are three distinct ways you're going to make money here. Way number one is capital appreciation. This is the classic buy low, sell high. You buy a share at $100 today, the company crushes it, and 2 years later, that share is trading at $150. You hit sell, and boom, you've made a $50 profit. Easy. Way number two is dividends. Remember how we said you're a part owner? If the company has a highly profitable year, they might decide to distribute a chunk of those profits directly to their shareholders. You don't have to sell your stock, you don't have to click a single button, that cash just magically drops straight into your bank account. And way number three, honestly, this is the real magic, is compounding. This is when you take those dividends, and instead of spending them on a new phone, you use them to buy even more shares. So now you're earning profit on top of your profit on top of your profit. Over a couple of decades, this multiplies your wealth in ways that literally seem like a math error.
Seriously, to prove just how powerful compounding and long-term holding can be, I want you to think about this staggering number, 75 times growth. Let's look at a real-world Indian example, Asian Paints. If you had just bought a single share of Asian Paints back in the year 2000, it would have cost you around 40 rupees. By 2024, that exact same single share had grown in value to around 3,000 rupees. That is your money multiplying 75 times over. And remember, that doesn't even include all the steady cash dividends they were paying out directly into your bank account every single year along the way. That right there is the real power of the stock market. It's not some quick money casino, it is a compounding machine for the patient investor.
Let's lock in everything we've talked about today with a super quick recap of our 5 core lessons. Number 1, a stock is simply a small slice of legal ownership in a real-world business. 2, you buy and sell these shares on the massive marketplaces known as the NSE or BSE, and you do it entirely through a digital broker on your phone. 3,
The Sensex tracks the top 30 BSE companies, and the Nifty tracks the top 50 NSE companies to give us the daily heartbeat of the market. 4. A bull market means optimism and prices are flying up, while the bear market means fear and prices are dropping down. And 5. You build actual wealth through capital appreciation, collecting those sweet dividends, and the ultimate multiplier, long-term compounding.
So look, we've built a rock-solid foundation today. You know the theory, you understand the jargon, and you see the massive potential. But I'm going to leave you with a very practical question. How do you actually, step by step, do this? If you have 5,000 rupees sitting in your pocket right now, which specific broker should you choose? What are the hidden fees they don't tell you about? And how exactly do you open this magical demat account safely without making a rookie mistake? Well, my friends, that is exactly what we are going to dive deep into in Module 2. Make sure you subscribe, hit that bell icon so you don't miss it, and as always, remember to market Seco. See you in the next one.